Hello, so in this video we are going to solve task-based simulation number 002597. So in this simulation we are going to talk about Player Incorporation, which is a publicly owned company in the United States, whose fiscal year ends on December 31st, and Palm Jones Vision CPA is a junior accountant tasked with preparing the year two numbers for the components of comprehensive income. So in this simulation we have total 7 exhibits, and first let's go through each of the exhibit. First they are talking about tax rate table exhibit, we are which we are which they are the tax rate of year 2 is given, which is 30%. 30%. I am going to highlight this because this will accepted as a tax rate for the whole simulation. Now let's take a look at the second exhibit, which is Baker Limited subsidiary exhibit. In this exhibit they told us that due to exchange rate changes through the year two, the final number of gain or loss is $26,250 dollar. Now take a look at the third exhibit, which is financial liability. In this exhibit we have elected to use the fair value option for several financial liabilities on our books. Instrument specific credit risk is to be calculated as excess of the total change in fair value relative to the change in the fair value attribute to the risk free rate bracket, in bracket defined for our purpose as the US 10-year Treasury note. In year 2, this is excess equal to 24,000. Now what does this exhibit mean? This exhibit simply means that the company has steps like bonds or loan, and instead of recording them at their historical cost, the company measures them at current market value, and every year the value may increase or decrease, and the change we have to record. Now take a look at the fourth exhibit, which is defined benefit plan draft note. In this exhibit, based on a discussion made in December year 2 finance committee meeting, the board decided to apply retrospective benefit associated with the defined benefit plan, and implemented in year 2 to all employees who have been working with the company since the beginning of year 1. The impact of this prior service cost will total approximately $72,000. Amortize of the impact is expected to begin in year 3 and will extend for approximately 6 years. Now what does this exhibit mean? This exhibit simply means that that a pension plan has started in year 2, and the company decided employees should also get the benefits for year 1. Now for this reason the company have to bear the extra cost of $72,000. Now let's take a look at the fifth exhibit, ledger balances. In this exhibit we got trial balance and pre-close and forecasted year-end balances after close. Now on Lincoln Division sale exhibit. In the exhibit we can see that the sale of Lincoln Division happened on November 30 year 2, and the company is following fiscal year, which is year end on 31st December, and so in this year total 11 months the company operated the business of Lincoln Division, and the sale price was $1.8 million dollar relative to carrying value on their book is $1.92 million dollar. And they are telling us to please also note that for the year the division lost on average $6,000 per month, and so they are operating in fiscal year, and the sale happened on November 30 year 2. So we also have to take the cost of $6,000 per month up to 11 months. Now let's have a look at the last exhibit, which is brokerage statement exhibit. In this exhibit, they are talking about two bond. One is GST bond and other one is TS bonds, and their fair value is given as on 31st December year 1 and 31st December year 2, and some notes are given. Let's go through the simulation now. Now so first we have to calculate income from continuing operation, and to calculate this we need to open the ledger balances exhibit. So, and in this exhibit we have to add goods sales, service sales, interest revenue, new gain on sale of fixed asset, and we need to subtract cost of goods sold, cost of service sold, administrative expenses, research and development expenses, impairment of AFS security, and loss from asset disposal. And we have to calculate this net of taxes, and the tax rate is 30%, which is given on tax rate table. Year 2 actual tax rate is 30%, and so we have to calculate this net of taxes. So how we will calculate this? We need to first add and subtract those numbers, and need to multiply the number with 1 minus 30% to get the calculation net of taxes. And here we get, and we will simply copy it from here and paste it here. Now let's calculate discontinuing operation. To calculate this discontinuing operation, we need to open the Lincoln division sale exhibit, and we need to subtract the original sale price of 1.8 million to the carrying value of 1.92 million, because the sale happened in loss. And also we have to record the 11th month loss, $6,000 per month net of taxes, which means 1 minus 30% to get the numbers for discontinuing operations. We will simply copy it and paste it here. And now we have to calculate pension adjustment. For this reason we have to open the defined benefit plan draft exhibit, and we have to record the cost of $72,000 net of taxes to get the number of pension adjustment. And we will copy it and simply paste it to the right column of pension adjustment. Now we will calculate AFS debt security. To calculate this AFS debt security, we need to open our final exhibit, which is brokerage statement. And in this exhibit they are talking about two securities, GST bonds and TS bond. And let's calculate the GST bond first. As we can see, the fair value of 31st December year 1 is given, which is 40,000, and fair value of 31st December year 2 is also given. And in the note of investor input, we can see that investment category as AFS security written down as impairment to value of $35,000 and March 2 year 2. So we have to record the change of $35,000 to $38,000. And you may be thinking that why we will not record the change from $40,000 to $38,000. That because we will not take $40,000 in this case, because AFS security recorded in market value. So the change of $40,000 to $35,000 $5,000 change is already recorded. Now we have to take the change of TS bond, $25,000 to $33,000 also both in net of taxes to get the AFS debt security activity. and we will simply copy it as usual and paste it to the AFS debt security. Now let's calculate foreign translation gain. Again, for this reason we have to open the Baker Limited subsidiary exhibit, and we can see that here we have a gain of 26,250 dollars, and we need to record it net of taxes to get the foreign translation gained, and put it here. And now time to calculate the final part of this simulation, which is instrument specific credit risk. For this reason we have to open the financial liability exhibit, which is our third exhibit, and we have to record the gain of $24,000 net of taxes to get our final answer, and we will put it here. Now we have done this simulation, and if we hit the submit answer button, we can see that we have done everything correctly. And one thing to remember, that in the discontinued operation we have a loss, and also pension adjustment, this is a cost, so we have to record record the numbers as negative numbers, because it's a cost or loss. So that's it for the exhibit. Thank you.